And remember, Christian, everybody looks at this, they come to me and say, Zane, what am I going to trade on? Am I going to trade on a multiple of EBITDA? Am I going to trade on a multiple of revenue? Am I going to trade on a multiple of gross margin? The answer is.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest on today. This individual has successfully created and sold 2 technology businesses, 2 publicly traded companies, which is obviously very successful. So you think you should listen to this podcast? You bet your ass you should. Make sure, obviously, you share this with your friend and your colleague, an executive that is struggling with having a successful exit. He has also completed more than 90 plus technology deals, including facilitating the sale of more of the largest lead generation internet businesses in the United States. He is also an entrepreneur, recognized expert on the growth and monetization of digital media, internet technology, and software companies. He's been in this industry over past 20 plus years. He is currently the partner and managing director of Founders Advisors Technology Practice. Please welcome my next guest, the one and only investment banker, as well as partner and managing director, Zane Tarence. How you doing today, Zane?
Hey, Christian, I'm doing great. Man, I appreciate that introduction. I'm going to have to come on your podcast more to get encouraged. That was exciting.
Well, man, I'm excited about having this conversation because I'm excited to unpack, because not only are you now looking back and helping a lot of founders that are in that mid-market, a lot of our audience that are, high 7-figure, 8-figure entrepreneurs that are wanting to scale, having those conversations, but you've actually had successful exits yourself. And one of the things that you mentioned here is you've understand, looking back at the traits, the necessary kind of key aspects to build a valuable company and have an exceptional deal and exit. Zane, I know this is kind of a 30,000-foot question, but I really want to start here as a foundation and then build upon it. When you're looking at that younger Zane, right, that didn't know how to exit properly on your first company, what were some of the big things that you learned in regards to KPIs, systems, processes, things like that, that helped you have that successful exit on that second company as well? What were some of those key attributes?
Christian, that is a great question. And again, it's a loaded question because, I don't know about you, but my first exit was when I was 34 years old. And I'll tell you, I look back, I was at an information disadvantage. I really didn't understand how to create enterprise value. I didn't understand how buyers and investors looked at risk-adjusted future cash flow. So first of all, I was a software engineer that didn't really understand how to create value, right? But when I look back, I would say the 2 things that I probably misunderstood the most is the calculus behind how important growth is. Growth is critical. Anybody looking at a private company, they're going to view you really on how fast you're growing and can you continue to scale, especially in your gross margins. So I didn't really understand the relationship of top line revenue growth, EBITDA growth, and how my gross margins participated in that. So that's what I'll tell you that I didn't understand. And by God's grace, or lucky, or however you want to call it, I ended up having amazing product market fit in my first company. And that's what allowed me to get successful. If I hadn't had that product market fit, I don't think I would have made it, Christian.
So with that being said, and I appreciate you being authentic and vulnerable and sharing, like, these are certain things that you were not aware of. And when you're looking at, working with a buyer, okay, what's the comfort zone in regards to year over year growth in regards to top line as well as EBITDA? Is there a kind of, sweet spot where it's like, hey, 5% year over year growth, or is it more that exponential that we're kind of seeing now where it's this, 50%, 20% massive growth in scale? Because it's obviously, as a buyer, it's hard to keep that consistent pattern of growth. But what are they kind of that sweet spot in regards to EBITDA and top line?
Christian, I'm telling you, you're on my hot button here. Most technology entrepreneurs understand there's a rule out there called the Rule of 40. And what it answers is the exact question you ask about the relationship of top line growth to your profitability. One of the most frustrating things to me was when people would say, Zane, you need to grow faster. Oh, but guess what? You also need to grow your EBITDA. It's like, how do you do both, right? Because what happens, Christian, when you're out there and you're growing top line like crazy? I mean, you're growing, doing great things. It destroys your income statement. Growth destroys your income statement because you're hiring more people, more customer success people, more product folks, opening new markets, doing more marketing, buying more PPC. And so this relationship between your profitability and your top line growth is more important than a funeral. In technology, where this started, typically it's the rule of 40. So you take your CAGR, your cumulative annual growth rate, okay, if I'm growing at 20% year over year, I look at my EBITDA margin. If that's 20%, 20 and 20 equals 40. I make the rule of 40. If I say, man, this year I'm just going to grow like a weed and break even. I grow 40%, but I'm break even. 40 plus 0 is 40. I still make the rule of 40, right? Now, here's the key. That rule started by a bunch of consultants in the tech world. It is now moving to every industry. So if you're a value-added distributor, it might be the rule of 20. Right? Because you don't have to grow as fast. Maybe and your margins are lower. So maybe you have 10% margins. You're growing at 10% a year. You make the rule of 20. If you're a pest control company, that by the way, a good one is trading like a software company because you have recurring revenue. Your rule is 28. I saw it the other day. If you're growing at 20% a year, you have 8% margins. You make that rule. So Christian, the relationship between growth top line and profitability tells me how healthy you are as a company.
So that's a really good, and it's really dependent upon each industry as well. Like you mentioned, you just gave some really good examples with regards to technology versus obviously, manufacturing or like pest control as examples. Walking back a little bit further in regards to that kind of consistent growth, I have seen in the industry, and I want to get your take because you're working on the front lines of a lot of founders in a lot of industries. But I've seen some where they got that massive growth, like you mentioned. They've been able to raise capital. They've been obviously getting a massive, beautiful valuation, but they're actually negative EBITDA. They have not actually pulled any positive EBITDA. And so my question, Zane, is what are you seeing holistically? Is that kind of like a nonchalant, like kind of one out of 1,000 that are actually building a sustainable, successful, consistent year-over-year growth, or is that kind of average? Are you seeing a lot where it's amazing valuations, amazing growth, but there is there is no positive EBITDA? What are you seeing in regards to the market and working with a lot of the people and the founders you have?
And again, I want to double click on this, Christian. You said it. It depends on timing. We're in a very different market today than we were this time last year. Okay. Probably from, I would say, August of 2020 after COVID until probably this time last year, it was grow, 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 grow at all costs. Investors were like, giddy up. We love it. We'll pay you for that. Let me tell you, it's shifted. And it's shifted. And one thing I know about business, it's all in cycles. Dude, I'm old enough. I have seen a lot of business cycles. It's in cycles. Okay. Right now, it is profitability. Investors want to know that you can sustain profitability. You're not just going to keep coming back and having a capital call every time. Oh, we could grow, but we need money. So it shifts. Now, are there companies still trading that are break even or not making revenue at unbelievable valuations? Absolutely. Here's why, Christian. It's super clear that that company can scale. Their gross margins are 85%, right? I mean, they're getting market share. They're growing faster than their industries and industry and competitors. And it's very clear financially that at any time I can slow down my expense on growth and start printing money. So it's like, get after it. We don't care about profitability right now. We care about market share. So what you're looking at, are your unit economics solid? Do you know how you spend money to create your product or service, how you price it, and how you make money? And that's where you get your gross margin. Christian, you said another point that's critical in this, and I wrote a silly book called The 17 Reasons Your Company is Not Investment Grade and What to Do About It. I was tired of seeing entrepreneurs building great companies. I had one entrepreneur, when I said, I got to write this book, they were doing $7 million in EBITDA, $7 million in profit. Couldn't sell them if my life depended on it because of some of these other factors. And one of those factors is compare yourself to the gross margin of your industry. If I could see one number in your financials, I'd want to see your gross margins. So let's go back to pest control. You're a pest control company. I can look at your gross margin compared to your industry, and I can tell you just like that if you have a competitive advantage. Technology in a SaaS business. If I look at your margins, say they're 88, percent gross margins, I can tell you in a New York minute if you have some competitive advantage that's allowing you to create your product and deliver your product less expensively than your competitor and price it the same, or you can do it for the same amount as your competitor to provide this product or service, but you can raise the price because your product's better. So gross margin helps you understand this relationship between, do I need to be profitable to get a deal done, or could I really get a fantastic deal done even if I'm not break even? So that's what investors are looking at, is your unit economics. Can you scale this business, and what are your gross margins?
Very interesting points, and let's dive into this a little bit further. So, in regards to EBITDA, I understand that there different industries have different multiples depending upon obviously what their numbers look like, etc. So, I do know like manufacturing has a 2x or whatever. Sometimes, depending upon obviously a lot more factors that go into it. So, SaaS tend to have a better multiple in that regard. I'm curious, Zane, in regards to margin. You mentioned this numerous times in regards to like obviously SaaS, because the expense of that is relatively low. You got pretty good margin in that. Are there kind of normal good boundaries or good kind of good margins in different industries that you kind of gravitate toward, like, hey, you know what, like you mentioned the pest control, since we're obviously kind of diving into that analogy, there should be a 30 or 40% margin. If it's below that, then there's some red flags that a lot of the buyers are looking at, or vice versa in regards to SaaS. Hey, you know what's going on here? You only have a 60% margin when normally in this industry is 80%. So I'm curious, I know it's very industry specific, 100%. But are there certain boundaries that you're looking at, or little red flags or green flags that you're saying, okay, hey, this is according to like you mentioned, obviously industry specific?
Yes. And the good news is, if you have an association in your industry, or a firm like ours that's an investment bank that has 20 sectors that we focus on as a bank, we know what those margins are, what is normal, right? Just like if I go to the doc, he knows for a 57-year-old guy like me what the normal muscle mass should be, right? He didn't compare me against you. He compares me against other 57-year-old guys. So the industry you're in is key. There's absolute commercial, average margins in each industry, and you need to compare yourself. It is irresponsible. Now I'm going to preach, okay, because I do this to myself, to not know what your industry margins are and where you shake into that. And that is the key to a wonderful enterprise value. Because again, if I have better margins in my pest control business than the average pest control business, and some of this is by region, right? Like in the United States, or in the southern region, in the Northeast, the West Coast. So it's by industry, and some businesses by region. Now, like SaaS doesn't matter in region, right? Because you can buy that anywhere. But if I have better margins in my pest control business, look at all the things that probably means. It probably means I'm hiring better people. They're more efficient. They're getting more customers serviced faster, right? I have a higher revenue per technician. I have a high net promoter score because my clients are staying with me. They're not churning. It is very expensive to churn a client. It's better to keep a client. It costs average 5 times as much to get a new client as it does to keep, an existing client. So just think about what that margin tells you about how that business is run. The efficiency of it, the back office, the marketing. I'm telling you, Christian, you let me see the gross margin by an industry that we have sector coverage in, I can tell you how valuable that company is or not.
That is the metric that you're looking at, that you're able to, obviously get it associated with other, industry companies like that, and you're able to say, hey, yes or no. Now, I'm curious, Zane, because I was talking to a friend of mine, and he's a M&A strategist as well, and he was talking about sometimes when they're exiting or, building out the structure for this company to sell for a buyer. Sometimes what they do strategically is almost, build everything out perfectly. And then there's always that one little thing that they don't do, maybe raising prices for the clients or whatever it is. so that the buyer almost licks their lips and go, strategically, that's an easy, easy sell or easy offer. Like, hey, let's buy this company because all we do is increase this. And now all of a sudden the value of that company is increased internally. So I'm curious, when you're working with some of these people, and I know this is kind of getting off to the more of the M&A side of things, but do you strategize with the founders like that in regards to saying, hey, not only are we looking at the margin, looking at the KPIs and certain things like that, but also, hey, these are low hurdles that when that buyer or private equity firm is coming in, you guys could easily, scale very quickly. Do you guys strategize that much, or is it more of like, hey, we're not going to do that. We're going to, make this exceptional. So this is an exceptional deal all around.
Okay, for sure. And here's the reality that we all know. There's no perfect company. Just like there's no perfect relationship, there's no perfect university, there's no perfect company. But what we do is we try to have a realistic view of the business and show all the strengths and highlight the strengths. But we also want to be self-aware. As a CEO or a management team of a company, one of the things buyers and investors hate the most is a management team that's not realistic, right? We got some issues, but here's the deal. We've got mitigation strategies, right? Here's what we're trying to do. Here's what we're trying to work on. So absolutely, let me tell you one of the main ones that private equity groups and strategics say, hot dog it. And again, I'm from the South, Christian. I got offices in Dallas, Texas, and Birmingham, Alabama. We call it leave meat on the bone. You can't, if you're running a perfect company, what is the investor going to do to get their return? Right? These investors feel like I'm value add. I have synergies if I'm a strategic buyer. Private equity group, I have all these operating partners. You absolutely have to leave meat on the bone. And so where we see it most of the time, and buyers get really excited, and they think these entrepreneurs that we deal with that have like $30 to $150 million companies, we're in the lower middle market, is sales and marketing. A lot of entrepreneurs are product centric or a little bit nerdy. We try to show, hey, if they were owned by you, smart Harvard private equity group that knows how to do marketing and sales and customer success, think about how much faster you could grow, right? Strategic, you could cross sell all these products in your tens of thousands of customers. What is that going to mean for you? So for sure, we want to highlight areas that buyer can add value. Otherwise, it's not going to be a great valuation. And remember, Christian, everybody looks at this, they come to me and say, Zane, what am I going to trade on? Am I going to trade on a multiple of EBITDA? Am I going to trade on a multiple of revenue? Am I going to trade on a multiple of gross margin? The answer is you're going to trade on whatever you're worth to a certain buyer. And there are a lot of wonderful buyers that will pay you a financial multiple, right? But then there's other buyers that are very sophisticated that have synergies and have areas where, oh my goodness, I could put the top sales manager in this company, head of sales or CMO, chief marketing officer. So yes, we're going to be very realistic, say, look at what the company has, look at this wonderful foundation, but oh my goodness, look at what they could do if they partnered with you smart folks, right? That's what we're trying to show. And again, Christian, one of the first questions any buyer asks an entrepreneur that's going to market looking for a partner, in the M&A space or trying to sell, why now? Why are you looking at selling now? You're showing me these graphs. It's all up to the right, to the north. You're growing like a weed. Your gross margins are expanding. Why are you selling now? What do you know that I don't know? And the answer to that, the right answer that we try to teach people is, I'm at an inflection point. When I sold my businesses, I don't know what I don't know. I know I have a great product. I know I'm getting pickup, but I need to professionalize this business, and I need a platform to where more people could know about my technology. And that's the reason. I feel like I'm being a poor steward of this opportunity, a poor manager, if I don't look for a big brother to help me leverage this. So let's giddy up and go. So anyway, that's the message that we want to project in all our modeling, our materials. And guess what? It's the truth. If you're a small company and think you can scale as fast as a big one, you're wrong. Whoever has the most money to acquire a customer wins every time. 30 years of doing this, thousands of companies watching them, failing. Christian, you were kind to talk about some of the things where it looks like, I won. I'm old enough. I got a lot of scars. I got a lot of crash and burns. And let me tell you, it's when I was independent, thinking I'm going to do this on my own, and a large competitor that had a lot of money, they caught me. You know why? They were able to hire the smartest consultants. They were able to hire better developers than me. They were able to go to market bigger. I'm telling you, whoever has the most money to acquire a new customer wins. And that's the reason you have to think about, can I do this on my own at a certain inflection point, or would it be smart for me to look at my options, which could just be take some capital, right? Take a few chips off the table, or it could be sell to a strategic. So I know I'm preaching, Christian, but I'm passionate about this, man. I have held on to companies way too long, thinking this thing's going so great, I'm going to keep doing it. Yeah, right. And then I got whipped by my competitor.
Well, you're bringing up some really good points, and I'm glad you're preaching because I think it's a very good things for our audience to hear and understand. There are a lot of different avenues that you can approach with the M&A side of things. You don't have to do 100%, sell. It is that strategic approach where you can work with someone that's been in the industry and they've got a whole bunch of team that's already scaled it,
Right.
hundreds of companies in that same boat that you can obviously strategize, and it's just fuel to the fire, and give some of your chips up. That's perfectly fine. Liquidate a little bit, and then being able to partner with someone that's, hey, you know what? Yeah, you own a smaller bit of the pie, but the pie is now much, much bigger. So it's a really good approach to talk a little bit about it. Now, Zane, I want to ask in regards to right now, this is an interesting market and at a macro and a micro level. And one of the things obviously we hit COVID, and now we've obviously hitting this whole market as well. One of the things I want to ask you, Zane, in regards to when you are strategizing with a buyer, okay, there are certain industries that were affected, obviously, with the times.
Right.
And what I mean by that is when you look at their margins, when you look at their EBITDA, when you look at their growth, it may have drastically decreased during COVID. It may have, we're seeing this with Stripe, for example. It's a really good example. The valuation drastically decreased from what it was in 2022.
Right.
So my point is, Zane, is when you're having that conversation with the buyer and these margins and the growth and these metrics, it's like, okay, there's something fishy. Why all of a sudden was your growth drastically decreased from 2 years ago, from obviously a year ago, vice versa, right? So there wasn't consistency over a 5-year period of time frame. My point is, Zane, is obviously the numbers, they have to develop a story, and you have to obviously sell that story, what happened during this journey and this evolution. And I think that is a very applicable approach to a lot of the listeners that are in that situation where, okay, they got a hit, and if they're looking to sell in the next 2 years, that's going to be on their financials in a 5-year journey, 7-year journey, et cetera. And people and buyers, rightly so, will have that conversation, that dialogue. How do you posture that? What do you say? How do you say it? I do know obviously some buyers will obviously give some context and some acknowledgement, but I'd love to get your expert approach on how to have that conversation, that dialogue between the buyer and the seller in those circumstances.
Yeah, and the key is, as you mentioned, growth is not always up and to the right. I mean, if you look at real companies, there are seasons just like there are for athletes, right? Just like there's games. Some games, you shoot over your average in basketball, some you're way under your average for a variety of reasons, right? And people understand that. So I tell entrepreneurs, don't shy away from the tough seasons. The tough seasons show what kind of company you are. You really don't know how quality, a company is until you see them under pressure. And so you want to look at a company over maybe a 3-year time frame and say, how are we doing? And if you dip 1 year, most industries are dipping right now. They're behind, in what they were same store sales or sales, year over year sales. And the reason is we got a weight vest on during our workout, brother. I don't know if a lot of your people work out, but CrossFit or whatever. I'm an old man, but I do CrossFit. When you walk in the gym and the coach says, oh, we're going to do the workout today with a 30-pound vest. Guess what? I can't do as many chin-ups and muscle-ups, right? Same thing in today's environment. There are headwinds, and we all have vests on. Here's the deal. Every industry faces the same kind of issues. So they're still going to compare you to your industry in a headwind market. If you're doing better than your industry, even though let's say sales are down 20% for you, okay, growth, and you're struggling a little bit, what if your industry's down 40%? They say that's an unbelievable company. They're going to come after you. So don't worry about seasons. Use that as an opportunity to say, here's what we did during COVID when COVID hit us. I get this question all the time. I see, buyers are in management meetings talking to sellers. Tell me how you reacted to COVID. In the middle of March of 2020, what did you do? How did you communicate with your team, with your employees, with your customers? They want to see how you act under pressure. Because one thing's for sure, it's not easy in business and you're going to hit other issues. So don't obsess over, oh, shoot, what was last quarter? You want to look at your metrics, but how are you doing compared to the industry? What management decisions are you making to navigate this ever-changing world of business? So don't get so caught up in anything other than how your industry's doing. Now, as I mentioned earlier, what's popular now, and I shouldn't even say popular, but what's right among investors, because they're hunkering down with a lot of their current portfolio companies, their investments, right? Trying to make sure they have enough capital to really help those companies they've already married, okay? But what is popular right now is not burning a lot of capital, showing that you actually have a real business where your product or service matters and your end users are buying it. And they're not canceling you just because they got to cut their budget 20% and you're one of the things they look at as fat. You want to show, and this is another element that creates value, that you are absolutely essential to your customer. If you can show that, again, that tells me you're worth a lot of money because you're going to be more resilient to these tough times. So don't obsess. You got to obsess about your numbers, but obsess about them compared to your competitors. If I go and work out this morning, I worked out, Christian, at 57, and it hurts my pride. But if I'm looking over at that 28-year-old that's deadlifting doing it, and I'm getting all worried, and I try to do that, it ain't going to be good. I need to obsess about how I'm doing against people in my cohort. And I only know two French words, brother, croissant and cohort. And cohort is an important one. Your market, your people, your classification. How are you doing with pest control companies your size that operate in the Northeast? That's what sophisticated investors are looking at to determine. And I got to say another thing, Christian. One of the best outcomes we ever had about 11 years ago, an outsized valuation that did not make sense for this industry. They sold for 2.5 times outside the standard deviation of the mean of what their market was trading for. 2.5 times. They were down in revenue 19% year over year. But guess what? Their industry was down 51%. And they got the most unbelievable valuation you could ever imagine. So I'm telling you, growth's important. It's critical. But this company was losing. They were 19% down. They still had an amazing outcome. Why? It's growth relative to your competitors at a certain time in the market. So anyway, long answer, but let me tell you, that's an important one.
I love that analogy, and I really appreciate you bringing that situation up because it is a very messy situation, right? Looking at a 3, 4, 5 year kind of history. But I love what you mentioned, Zane, in regards to building that context according to that cohort, according to obviously your industry specifics, because then that gives you a little bit more color,
That's right.
a little bit more story and context in regards to, okay, hey, what is this actually telling us? If the market was down 51%, but you only dropped down 19, well, you're not looking too bad. So it's all really kind of relative according to obviously where they're at. So a lot of buyers are in that when they're looking to buy, they obviously bring that that context to it.
That's right.
Really, really incredible, and I love that. Zane, I want to talk a little bit now. You mentioned, of course, really decreasing that burn rate. and then really expanding that runway. A lot of businesses that I've talked to, they're maybe expanding it to 2025. I don't know. From what I've heard, it's just very interesting to see. That's depending upon your startup and so forth. But I want to ask Zane in regards to like what are you seeing in the industry? You work with a lot of different industries, a lot of different founders. You mentioned obviously decreasing the burn rate. Is there a specific percentage that you'd like to see that it's like, okay, hey, let's decrease this by X percent, and then as well as then you can anticipate with that burn rate how long of a runway.
Right.
Is there a typical right now when there is turmoil, when there is uncertainty, which naturally this is an ever evolving, whether it's 20 years down the road or 30 years down the road, this is a very applicable approach. Zane, how do you structure, how do you think about it, definitely with the companies that you've sold and the people and the founders that you're working with?
Yeah, and first of all, on extending the runway, and this is advice, Captain Obvious here. But let me tell you, a lot of entrepreneurs, this kills them. Christian, they run out of money. You're like, oh, well, I'm not going to run out of money. Sales are going great. No, you sell yourself out of business. In a capital market where there's not as much capital from the debt markets or the private equity markets, you got to be really careful with your balance sheet. So what I recommend is make sure, and this is the job of a CEO, is the survival of the business. Make sure you are really being prudent and fastidious around your balance sheet. Whoever has capital in a down market creates incredible wealth. You know why? You can buy your competitors. You can buy adjacent companies. You can hire the best people. When everything's going great, 2021, I couldn't hire a banker to save my life. Now, it's good market because people are like, ooh, the company I work for doesn't have a good culture. I'm afraid they're going to fire me. So extend your runway, survive another day, another quarter, so that you can take advantage of the chaos that is in the market. Listen, if everything's up and to the right like 2021 all the time, it's very tough to build value because it's easy. You just have to be in the game out there and catch the dollar bills, right? That was easy. Now let's see how you're really doing, right? So have money, extend your runway so you don't have to make unnatural decisions. And you get that terrible thing when an entrepreneur comes in and says, oh crap, I can't pay payroll next week. What am I going to do? That destroys your culture when you start having to react like that and let people go. So extend your runway by being very careful with cash. Also, there's so much money right now on the sidelines. People are like, wait a second, people really aren't investing now. What's going on? There's so much money on the balance sheets of strategic buyers, and private equity groups have more money than they've ever had in history. They're just backing off a little bit for a little while, right? But they're still looking because they know this as well. If they can find a quality platform company that's healthy, now's the time to invest. Now's the time when you make a fortune. You don't want to invest when the market's super high. You want to invest when it's a little depressed in a great product. So extend your runway by capital preservation and knowing your options. You said my favorite word a minute ago. Entrepreneurs don't know their options. Most of them think, oh, I have to sell my business or keep it. There's 8 or 9 options, big category options. And with each one of those categories, there might be 20, 30 options. Entrepreneurs that have a healthy business, even a small business, tons of capital opportunities, okay? So extend your runway, be there. I will tell you one other thing that we're finding fascinating right now as we're looking at, early March here in the M&A market. Deal volume's down. But we've done a good many deals already this year still. And let me tell you, some of them have incredible valuations. You know why? There's not many deals on the market. There's a supply problem. What happens when there's not many companies for sale and there's a ton of money out there? It's driving up the valuations of the quality companies. In 2021, if you weren't A+++ filet mignon, you couldn't get anybody to look at you. And so many companies were selling because, the market's so hot. Well, now there's not many. These buyers are chasing very few deals, and deals we've gotten done this year, Christian, are about as high as valuation as we did at the top of 2021.
That is actually a very interesting point. I never thought. I do know the private equity, they are sitting on a lot of money. A lot of large corporations are sitting on a lot of money. There's still a lot of money on the sideline
Right.
that are ready to deploy. And so what you're saying right now is that you are seeing, because the supply demand is kind of off, you're actually seeing the valuation go up,
Absolutely.
and people are still looking out there deploying that. That's very, very exciting. Zane, I know you guys work in a lot of different industries. Is there one industry that you're noticing as a little bit more fire behind it, more so than other industries currently in regards to that supply demand ratio?
Yeah, yeah. And I'm going to tell you the fire, and this could be the bad kind of fire, but also the good. The world that I'm in, I'm a software engineer. I worked for IBM forever. They funded my first business, 23 years ago. It's the way I got ultimately in investing and being a river guide for other software entrepreneurs. So I'm a technologist, right? Technology was hit harder than anybody. You just have to look at the public markets, right? The public technology stocks were down on average. I think the SaaS companies about 55% the last year. 55%. If you were worth, $1 billion as a public company, you're worth 500 million now. Now that affects private companies. Obviously, the way public companies are trading affects private companies, and public companies are better. They get higher valuations because the size typically a lot bigger than private software companies, and also there's liquidity. As an investor, I can go sell 10 shares, right? In a private company, I can't do that. So technology was just lambasted last year. And so what's happened, a lot of nice private software companies are saying, I'm not going to go to market in this terrible down market. I'm going to wait. Okay. So technology is what was really, really hurt. Also, anything inflation related, building materials, inflation was so high, people's revenue went through the roof, but it was a false revenue, Christian. Their revenue went through the roof because the price of lumber went up 60%, right? And so that's a false narrative. And so in some of those industries, you have to readjust for inflation. So inflation really, it looks like all these companies were growing like a weed, but it was just because of inflation. So anything inflation oriented, there's real adjustments in, and anything tech oriented there is. But guess what? I said it earlier in the podcast. It's all about seasons. The only thing I know about American business, I'm not a prophet, business anywhere, it's a cycle. And there have been 9 major cycles in the U.S. economy since the Industrial Revolution. Understand how to play those cycles. Don't get discouraged. You get wealthy. You create incredible enterprise value in a down cycle. That's when you make money. You might not get paid until the cycle's back up, but you are creating stupid enterprise value. So think about, I'm glad there's confusion in the market because I have an amazing culture at my company. I'm gonna prove how solid we are, how we manage capital. We have a balance sheet, we have access to capital, and I'm gonna go recruit the best people. And I'm also gonna hunker down and invest in my customers that I currently have.
I love your approach. I love the excitement as well. I'm getting pumped up because I do see there's massive things where you're building the foundation now and you're taking the uncertainty brings, facilitates opportunity. And for those that obviously can think long term, 3, 4 years down, when everything goes back up and rock and rolling, whatever that looks like, whatever that timeline is, you want to be in a situation where like, hey, I'm glad I did what I had to do during this time instead of, oh man, I wish I would
That's
have,
right.
right? That concept. So Zane, I really appreciate that excitement, the way you look at it. In regards to what you kind of mentioned, you mentioned a little bit off the line, and I want to talk a little bit about this. You talk about there's 2 different strategies that a lot of individuals should be kind of really focusing on in regards to really just maximizing their growth, but also their margins. One is obviously you just mentioned numerous times the talents. There's a lot of talent out there right now making being observation observing that there's a lot of talent, having that conversation as well. You want to make sure that you decrease the burn rate. And one of the biggest expenses is hiring new talent, of
That's
course.
right.
However, though, it's the same thing as buying an asset. It is relatively lower. You can obviously negotiate that conversation instead of paying someone 150K for something. You can maybe get them for 100K and
Yes.
different stuff. So I'm noticing you can get better talent for a little bit less because obviously in the tech world we've seen a lot of people lay off. So for those that you're talking to, a lot of your founders, right? How are you kind of structuring that conversation, saying, "Hey, you don't want to overhire, but you do want to maybe let go of the individuals that got you to where you're at, and to get you where you need to be, you need to hire better talent, of course." So that conversation, that dialogue, without obviously increasing the burn rate and too expensive, expenses. What does that dialogue or that conversation
Yeah,
look like there?
yeah, huge balance here, Christian. And as you and I have talked before, offline, I'm a fanatic because anybody that's studied business knows this truth. Exceptional people create exceptional results. So as a leader, you always have to be a talent scout. First of all, internally, have you force ranked your current team? Here's the most important person. People, I don't like doing that. Well, then you're not going to be a very good CEO. Every coach does it. Every band director does it. Every orchestra director has a first chair, flute, second chair. Have you, first of all, force ranked your team? If you have 50 employees, who are the 5 most important people? 1, 2, 3, 4, 5. And in downtimes and every time, you need to focus on those people. Guess what most entrepreneurs do? We focus on our C players because they're the ones taking time and energy. And some of them are sweet. Some of them are so nice. They helped us build our company to this stage. But guess what? You've outgrown them. So the first thing you do is you work on your top 10%. You love them. You take care of them. You have quarterly conversations with them. You work on their development plan. You figure out how to get them long-term incentive packages, LTIP plans. You figure that out, number one. And that'll all be happening all the time, especially in bad times. Number 2, then the most loving thing you'll ever do is get those C players off the bus. And this is where I'm terrible. My personality, I love people, and some of the sweetest people ever that have helped me build my companies. They're just great people. But guess what? The company outgrew them. And it's an abuse to your A players. If you have an offensive lineman on your football team and your team outgrows their ability and the defensive nose guard is pushing over your center every play and tripping your quarterback, that's awesome. That's irresponsible. You have got to work on that position if you care about the common good of the team or the company, right? So you got to get your C players off the bus during these times. It's a great time to say, I love you. I want to help you. I'm still going to help you. Even though you're not with my company, I'm going to help you find a better job. You got to get them off the bus. Then that leaves room to go and bring on talent efficiently. This is the time to clear out some of the people that should be cleared out lovingly, and then bring on that new talent. And I'm telling you, a time when things just aren't all hunky dory is a time to focus and do some of these hard things. But Christian, I know you probably heard of this guy, Patrick Lencioni. He wrote The 5 Dysfunctions of a Team. I think he sold about 50 million books. He's written several books and about business, just unbelievable. And I had a chance to spend dinner with him one time, and he said the most unloving thing you'll ever do as a CEO is keep somebody on the team that doesn't qualify, because way deep down they know they don't have the skills or the talent to do what they need to do for your business. He said the most loving thing you'll do is help them get off the bus. Here's the other thing he talked about, and all the research is showing this. The difference in an A player in a role and a C player isn't that the A player is 30% better than the C player. They're 5 to 7 times better. If you've ever seen a B software engineer, and if you've ever worked with an A plus software engineer, that A plus software engineer isn't 30% better. They're 20 times better. You can put 50 B software engineers in a room, go figure out the requirements, build this software, make it better. You give me one A plus engineer, they'll build a beautiful, more productive, faster piece of software than those 50 people. Now, they still need a quality assurance team. I'm telling you, if you've ever seen a B or C salesperson operating in a demo of a piece of software or selling somebody, hey, I want to put a new roof on your house, and then you really have been exposed to an A plus salesperson that knows how to ask the right questions, that knows just how to really show the empathy they care for this customer. I want you to buy my roof because it's going to be better for you. It ain't 30% better. Sorry to use ain't. It's 10 times better. They will have a conversion rate 10 times better than to be. So we've got to be realist. We don't deserve to be a CEO if we can't candidly look at our company and say there has to be some decisions made here. And now's the time to do it. And guess what? A players are attracted to A platform businesses, to leaders that are willing to make the tough calls, but are also sincere, have character, are willing to tell the truth, even when it doesn't make you feel good. That's the kind of people A players want to work with. So that's my suggestion. Get rid of the C players and replace them with some A players.
Zane, you're preaching, and I love this because I got a friend of mine that runs a mid-nine-figure business, and he's like playing Monopoly with this. The exact strategy you mentioned, where he's like, taking one house and making it a hotel kind of concept, right? Hey, get rid of 5 individuals to get one big one, and
Yes.
A player, right?
Yes.
And like you mentioned, it is that conversation, it is that dialogue, it is that way of thinking, and sometimes you don't have to, increase. In fact, you can decrease the expense just because obviously you're getting rid of a lot of unnecessary. And you also, like you mentioned, Zane, in the regards to the way you approach it, is you're actually blessing them by getting them off the bus and getting them on another bus that obviously is a better vehicle for them in their situation, whatever it may be. So you have to just put it into context and reframe it the right way.
That's
So
right.
I appreciate you just explaining that. One thing also you mentioned, Zane, and I found this very interesting, is you've worked with a lot of private equity in regards to obviously buyers. And they come in, and one of the biggest approach is obviously, increasing the price.
That's right.
Now, not only the increasing the price, I think we've heard this. However, though, I was wondering, is there a specific margin of how much you increase the price to, whether it's enterprise or SMBs, right?
Right.
It depends obviously what industry or what kind of audience you're looking for. Is there a specific price that you'd like to increase it to? Like okay, we're going to increase it by 10%, 15%, 20%, 30%, maybe, whatever it may be. Like let's start 3,000, now it's 30,000. Like what is that? Or maybe it's 3,000, now it's 15,000. How to approach that pricing structure, and then as well as with the economy going on, is there a little bit of fear of uncertainty where you increase that churn rate?
That's right.
I'd love to get your response on that.
Yeah. And listen, the worst thing for a wonderful business that has reoccurring or recurring revenue, those two types of revenue are the most valuable. The worst thing that can happen is you trigger churn going up. That's terrible because risk adjusted cash flow is calculated in the models of these investors, right? And churn, a leaky bucket, ain't good. So we don't want to do anything that causes customers to leave. So to answer your question, the consultants that I see private equity groups bring in around pricing are unbelievable. And this is hard. This is hard work. But the way you do it, you don't come in saying, I got to raise them 30%. You come in with a study. What is the price? What is, for the value I'm providing in my industry, what is the premium price that my competitors are charging? And you do a study to see areas where you can raise that price thoughtfully, stretch it to where you won't lose those people. So you don't come in and say, I got to raise the price 20%. You do a study, and that data, in God we trust, all others bring data, tells you exactly how to move the pricing. It's no different, Christian, than if I was coming to your city and buying real estate, right? And I had a lot of apartment complexes. What happens if I haven't checked your market out in 3 years and I've never changed my price? I look around, the tenants aren't going to tell me. They know. Then I'm $400 a month less expensive for my type apartment complex in Jacksonville, Florida. I'm being an idiot. I need to raise the prices. And if I raise the prices correctly, are those people going to move from my apartment complex? No, because I'm right in with the market. So all about market research. And most entrepreneurs have owned that apartment complex for 3 years and they haven't looked at the prices. They've gone way up. I would say in 95% of the deals I do, we do about 22 institutional deals a year amongst our 40 bankers. I would say in 85, 90% of those deals, the new buyer raises the prices because the rent was way too cheap. And guess how many customers, I've told you this before, Christian, guess how many customers leave? None. None. If your product market fit was good, if they're happy with your current apartment complex, they're going to be like, why are you raising the price on me? Well, they know the apartment complex across the street is $400 more. You just didn't know it.
So with that being said, and I love that approach in regards to grabbing the right data and making sure that there's a lot of market research before you obviously just it's not like one fits all. Hey, 30% we're going
That's
to
right.
raise, and it doesn't matter what industry, what product, whatever. It is very contextual depending upon obviously the research that you gather and the data that you gather. With that being said, then Zane, I know like the psychological aspect as well, where it's that perceived value, right?
That's
So if
right.
you're going to increase the price, you also want to increase the value, the perception that there is also you're getting more for the value of it. So with that being said, and I know this is very contextual dependent upon each industry, but is there also some validity in that when you are raising and obviously gathering that data and saying, okay, hey, you got this, this, and this service, but also we're going to go ahead and add this
Yes.
other perceived, value, et cetera, to increase that price. How do you structure that?
Yes. And Christian, you nailed it. You never raise a price without saying, hey, we're going to give you, this is the reason we're doing this. It's because we have new features and functions we're going to open up for you, new data. In the example of the apartment complex, why wouldn't I say your rent's going up $400, but guess what? We're repainting the facility. We're redoing the workout room. We're adding a new pool. Of course I do that. And so in your software, especially, it's so easy to add a new feature. You were doing it anyway. And so, yeah. Or if you're a pest control, lower the service level, agreement to where you're there, an extra time every 6 weeks to look at the mosquitoes. That didn't cost you much more money, and you're going to charge them another $200 a month or $100 a month. That's what you do. So you're spot on, Christian.
Well, awesome, Zane. Well, thank you so much for sharing that because one of the things that I know a lot of our audience is kind of focused on is really having this dialogue with their team, saying, okay, during this uncertain time, there are those that are very aggressive. If you know and you've been through these cycles before, you just realize that, hey, these are just cycles. These are same patterns that you can obviously analyze from previous years and then apply that same knowledge in how to build the right boundary systems, strategies, and tactics to ensure that you build the foundation to be aggressive in the coming years that are going to be up to the right trajectory. Zane, I really appreciate you being on here and unpacking this at a very deep level. For those that obviously have more questions that will want to, ask a little bit more, get a little bit more, having this conversation, how to structure this maybe. For those that are listening that want to reach out to you, Zane, how do they reach out to you and be part of what you got going on, man?
Yeah, no, thank you for asking. And one of the things we try to do, because we love entrepreneurs, because I'm one of them, is provide a lot of content. And so, best way to get us is really foundersib.com. www.founders, like the founders of a company, I as in investment, B as in bank.com. And we're all there. I have my email there, my phone number there, and we have a lot of content. The books that we've written on how to create enterprise value. We just built an assessment, free. This is all free. We make our money when we do deals, but we work with clients 3-4 years before they ever do a deal. You don't pay us anything. We want you to grow a great company where you want to do a recap. So we have assessments. We can actually take these assessments in the 25 industries that we have sector coverage in and really see, am I investment grade? And so we have those assessments there. And then also we do a lot of workshops, and probably our event that's become the most popular event, Christian, is a deal we call Silicon Y'all. So a website, Silicon Y'all, in the Deep South. And we have 20 of the top software and tech private equity groups in the world really come into Birmingham, about 150 that apply, but we only invite 20, and we invite 80 of some of the top micro from 5 million in revenue to about 50 million in revenue CEOs that have never really raised capital. They're pretty efficient, but they built great companies. And so we do that event too in October every year in Alabama. That's a big deal. We'd love people to look at as well. So siliconyall.com or foundersib.com.
Awesome. And guys, those links are in the description below. And again, just like Zane was mentioning, they do have a lot of content out there. So I'll make sure I put all that information. Make sure you go in there, consume that. For those that are listening, a lot of times you don't know all the options. You don't know all the different avenues until you talk to someone like Zane that's able to maybe navigate this properly because he's done hundreds upon hundreds of times. So Zane, for those that are listening, those are in the description below. Zane, I really appreciate being on here. I always love to ask my guests before I let you go fully, You've done very well for yourself, and you've helped a lot of people. Now you're mentoring a lot of other founders to be able to scale and think properly to build the right foundation of a business. And while you're doing this, Zane, what insecurities did you have to overcome to become the successful
Mhm.
Zane that you are now?
Wow, that is a good question. I'll tell you, I'm gonna be real vulnerable. I hope my competition doesn't see this. My formal education, and I'm not speaking against my alma mater, Auburn, and I have a master's degree in theology. Okay, I worked for IBM for 12 years, and I was a software engineer. But in the world I'm in now, investing, helping customer clients do M&A deals, most of my competitors, their educational pedigree is just, I mean, Wharton, Harvard, Stanford, and I'm going to tell you, I got a chip on my shoulder about that, and I'm sensitive because those kind of pedigrees do matter. And so I'm probably insecure about my formal education, but you know what, Christian? It's made me work harder. It's made me be a voracious learner. I read like crazy. And guess what else I do? I hire people from those schools. So I might not be the person, but guess what? I got them all around me, baby. So anyway, that's one of my biggest securities. And then I'll be real vulnerable. I'm a stutterer. I don't know if you've noticed this, but I'm getting better. But as a little kid, I stuttered, and that caused me not to want to talk much. And by working hard, by having some good folks helping me, that's an insecurity. And at times, if I don't get enough sleep or drink too much coffee, I can stutter. And that physical element has sometimes held me back from taking risks. If I get nervous, I'll start stuttering. And you know what I found out about my vulnerabilities? The more I share, the more people see those, the more they like me. They don't want anybody that's they feel like. So when I say I'm a stutterer, sometimes I want to try to stutter because people like me more and they're like trying to root for me, like, oh, I hope you can get that word out, Zane. They like me more. They become my client. So stuttering and my formal education.
Zane, I really appreciate being authentic and vulnerable, and I would not have known that you struggle with stuttering at all. And I do know in the investing world, it is all about sometimes that Harvard, Yale, Wharton, all that fun stuff. But at the end of the day, you went out there and accomplished the successes you've had, regardless of that. And I appreciate you sharing that, guys. That is my friend, the partner and managing director of Founders and Advisors Technology Practice, the one and only Zane Tarence. Guys, that is Journey with Christian Evans podcast. Until next time. Be uncommon if you can.